Welcome to Tax Takes. My name is Gay Proberts Camp. In this video, we'll review the application of the capital gains tax rules when there is a change of residence. As you watch this video, I recommend that you have your learning materials open so that you can highlight key sections and add your own notes. You should know from your studies that a net capital gain is calculated and included in a taxpayer's assessable income under Section 102-5. However, a net capital loss is carried forward and can be used to reduce capital gains in the future. Australian resident taxpayers are subject to tax on CGT events relating to their worldwide assets. However, under Section 855-10, a non-resident taxpayer is only taxable in Australia on CGT events happening to a CGT asset that is taxable Australian property, or TAP. Due to this difference in the scope of CGT, if a resident taxpayer becomes a non-resident taxpayer, many of the taxpayer's CGT assets will cease to be taxable in Australia. For this reason, CGT event I1 applies when the taxpayer stops being an Australian resident. This event deems there to be a disposal of each of the taxpayer's CGT assets at market value other than taxable Australian real property, or TARP. However, an individual taxpayer can choose to disregard the capital gain or loss from all CGT assets covered by CGT event I1. If this choice is made, each of those assets is deemed to be taxable Australian property and will therefore continue to be subject to CGT in the future when they are actually sold. You should also know from your studies that as the definition of a CGT asset is so broad, just about everything is included. Therefore, the scope of CGT is limited by the application of exemptions. A common mistake made by candidates in an exam is to forget that these exemptions can be applied when calculating a deemed capital gain or loss under CGT event I1. And finally, you should know that an individual taxpayer may be entitled to the CGT 50% general discount. This discount can apply where the CGT asset has been held for more than 12 months and the CGT event occurs after the 21st of May 1999, provided the cost base of the asset has not been indexed. The requirements for application of the 50% general discount are covered in detail in your learning materials. So what is taxable Australian property? Taxable Australian property is defined in Section 855.15 to include taxable Australian real property, or TARP, under Section 855-20, that is land and anything fixed to land such as a building, indirect real property interests under Section 855-25, that is shares in a company where the taxpayer holds 10% or more, and more than 50% of the underlying assets of the company are TARP, or in other words, a non-portfolio interest in a land-rich company. Assets of an Australian permanent establishment or branch, a right or option to acquire TAP, and assets where an individual taxpayer has chosen to disregard the capital gain or loss on ceasing to be an Australian resident. The inclusion and exclusions from the definition of taxable Australian property are explained in detail in your learning materials. So let's consider an example where an individual taxpayer becomes a non-resident. In this example, Jerry ceases to be an Australian resident in March, and his post-CGT assets at that time include an apartment in Sydney, Australia, an apartment in Hong Kong, China, and shares in an Australian resident private company that does not hold any direct or indirect interests in Australian land or buildings. You are required to explain the CGT consequences for Jerry on ceasing to be an Australian resident. Remember, explain is the task word or verb that we use to express what you need to do and to what depth. Explain means you need to provide a reason for the tax consequences for each of his post-CGT assets. It is also important to note the other specific requirements of the example. You are also told that Jerry has not made any tax elections. Therefore, he has not chosen to disregard any of the consequences on ceasing to be an Australian resident. Let's review the solution. Once Jerry is a non-resident taxpayer, only his taxable Australian property, or TAP, will be taxable in Australia. Thus, when Jerry stops being an Australian resident, CGT event I1 deems the disposal of all of his post-CGT assets, other than the type of TAP that is known as taxable Australian real property, or TARP. As the apartment in Sydney is located in Australia, it is the type of TAP known as taxable Australian real property, TARP. Therefore, CGT event I1 does not apply to deem the disposal of this asset. Jerry will instead be subject to tax in Australia when the apartment is actually sold. As the apartment in Hong Kong is located overseas and not located in Australia, it is not taxable Australian real property, or TARP. Therefore, CGT event I1 applies to deem the disposal of this asset at its market value at the time Jerry ceases to be a resident. Jerry will not be subject to further tax in Australia if the apartment is sold while he is a non-resident. The shares in the private company are not the type of TAP known as an indirect real property interest because the company is not land rich. That is, the majority of its assets are not TARP. Therefore, CGT Event I1 applies to deem the disposal of the shares at its market value at the time Jerry ceases to be a resident. Jerry will not be subject to further tax in Australia if the shares are actually sold when he is a non-resident. So let's check your understanding. What if Jerry sold his Sydney apartment for $2.5 million while he was a non-resident? What are the tax consequences for Jerry? The correct answer is that Jerry would be subject to CGT on disposal of the apartment as it is taxable Australian property. So even though he is a non-resident, he would need to lodge an Australian income tax return and include his net capital gain in his Australian assessable income. When Jerry calculates his capital gain and net capital gain, he needs to consider what exemptions and special rules might apply. If Jerry used the Sydney apartment as his main residence at any time, then Jerry may be entitled to a partial main residence exemption. Also, as Jerry is an individual taxpayer, where he has owned the apartment for more than 12 months, he would also be entitled to the CGT 50% general discount for the portion of his capital gain that accrued up to the 8th of May 2012, if any. As Jerry is a non-resident, he is not entitled to the 50% CGT discount on the portion of his capital gain that accrues after the 8th of May 2012. Jerry would also be subject to CGT withholding tax. The purchaser would be required to withhold 12.5% of the purchase price from the sale proceeds and remit this to the ATO. So when Jerry lodges his income tax return, his income tax payable would be reduced by withholding tax he has already paid. Remember, this type of withholding tax is not a final tax. Jerry still has to complete an income tax return and determine what his actual Australian liability is. So let's change the facts again. What if the shares in the private company owned by Jerry Brand were taxable Australian property? What are the taxation consequences for Jerry when he ceased to be an Australian resident? The correct answer is even though the shares are a type of TAP known as indirect Australian real property interest, CGT Event I1 will deem the disposal of the shares at their market value at the time Jerry ceases to be a resident. As an indirect real property interest is taxable Australian property under Section 855.15, Jerry will also be subject to CGT when the shares are actually disposed of under Section 855.10. Therefore, to ensure there is no double taxation, the indirect real property interests are deemed under Section 104-160 to have a cost base equal to their market value at the time the taxpayer ceases to be a resident. Or in other words, Jerry would be subject to CGT in Australia at the time he becomes a non-resident on any increase in market value up to that time, and subject to CGT in Australia when the shares are actually sold on any further increase in market value after that time. So now let's check your understanding when we change the type of asset held by the taxpayer. What if Jerry Brand also owned the following post-CGT assets at the time he ceased to be an Australian resident? What are the tax consequences for Jerry? The correct answer is there are no tax consequences. As the vintage motor vehicle is not taxable Australian real property, Jerry would be deemed to have disposed of the asset at its market value at the time he became a non-resident. However, because the asset is a motor vehicle, the capital gain of $10,000 would be disregarded under Section 118-5. It does not matter that it is a vintage car. All motor vehicles are exempt assets for CGT purposes. As the artwork is not taxable Australian real property, Jerry would also be deemed to have disposed of the asset at its market value at the time he became a non-resident. However, because the asset is a collectible with a cost of $500 or less, the capital gain of $11,600 is disregarded under Section 118-10. As the yacht is not taxable Australian real property, Jerry would be deemed to have disposed of the asset at its market value at the time he became a non-resident. However, because the asset is a personal use asset, the capital loss of $7,000 is disregarded under Section 108-20. A capital loss on a personal use asset is disregarded irrespective of its cost. However, if Jerry made a capital gain on his yacht, the capital gain would not be disregarded under Section 118-10 as the yacht has a cost of more than $10,000. So let's further check your understanding, but this time let's consider what happens to post-CGT assets when a taxpayer becomes an Australian resident. What if Jerry became an Australian resident again 3 years later? What are the CGT consequences for Jerry's Sydney apartment? The correct answer is that, as the apartment in Sydney is located in Australia, it is taxable Australian real property TARP, which is a type of taxable Australian property. Therefore, there were no CGT consequences when Jerry ceased to be an Australian resident. That is, CGT event I1 did not apply to deem the disposal of this asset, and there are no CGT consequences when Jerry becomes an Australian resident again. What this means is that the Sydney apartment is subject to tax in Australia when it is actually disposed of, irrespective of whether he is a resident or non-resident. However, as noted earlier, when Jerry calculates his capital gain and net capital gain, he needs to consider the exemptions and special rules that might apply, including the application of the main residence exemption and the CGT 50% general discount. If Jerry became an Australian resident again 3 years later, what are the CGT consequences for Jerry's Hong Kong apartment? The correct answer is that, as the Hong Kong apartment is located overseas and is not located in Australia, it is not taxable Australian real property. Therefore, CGT event I1 applied to deem the disposal of this asset at its market value at the time Jerry ceased to be an Australian resident. And Jerry is deemed to have reacquired this asset for its market value at the time he becomes an Australian resident again under Section 855-45. What this means is that any increase or decrease in the market value of the Hong Kong apartment while Jerry was a non-resident is not subject to tax in Australia. Or in other words, if Jerry had sold his Hong Kong apartment before returning to Australia, that is, while he was a non-resident, there would be no taxation implications for him in Australia at that time. He was deemed to have disposed of the asset when he became a non-resident. However, if he sells his Hong Kong apartment after he returns to Australia, that is, while he is a resident, he'll be subject to tax in Australia on the difference between the market value at the time he became a resident and the capital proceeds he receives on the actual disposal. Once again, when Jerry calculates his capital gain and net capital gain, he needs to consider what exemptions and special rules might apply, including the application of the CGT 50% general discount. Good luck with your studies, and I look forward to chatting with you again soon.